Well, thank you very much for joining us. This is Andrew Waite from Personal Real Estate Investor, and I would like to introduce you to my friend RJ Palano, who is the acquisition specialist at Buy Cash Flow Properties. TurnKey Solutions for Atlanta, Georgia, and what we are most interested in with Buy Cash Flow Properties is the way they approach the market. They're very, very selective about many of the houses they buy, or all of the houses they buy, and they stay away from many of the neighborhoods. One of the things that we're seeing at the moment is this rush for yield, and the problem is the yield is what people show you now on a pro forma and sometimes a actual return spreadsheet, but they're snapshots of performance in the current environment and often not designed for long-term returns, merely designed for the sales representations that promise long-term returns. What you then run into, of course, is sustainability over the life of your investment, because you don't just buy a snapshot, you're buying something in the buy and hold model to hold for a number of years, and the assumptions are always made that they perform continually through those years at a very predictable manner. Bad neighborhoods don't perform continually over very predictable hold time. So what I'd like to do is introduce you to RJ Palano. RJ, welcome.
Hey, Andrew, thanks so much. Good to be with you. And we're going to grip it and rip it and run through this presentation because I want to be concise, to the point, and give very accurate information. So we all know that the best time to buy is when others have to sell. And in America, for the last few years, you got Fannie Mae, you got Freddie Mac, you got the FDIC when they come in to take over a bank, you have HUD, and you've got regular lenders that need to reduce their portfolio. They need to get these bad assets off their sheets. So right now is the best time to buy, and there's a lot of reasons for that. We're going to go through it. So in this presentation, I'm just going to give you a very quick overview so you know what to expect. We're going to tell you who we are, what we do, what our investors' needs are, why we've selected Atlanta, some mishaps that happen for investors, and we're going to show you some pictures of the wrong house in the wrong area. We're going to show you the right house in the wrong area, and then we're going to show you the right house in the right area, which is really important to make the distinctions where you buy. We're also going to discuss our common sense approach to business, what our investors get, and we're going to give you the unveiling of a new model for investors that's going to be very limited, and it's pretty exciting, and I think people are going to really like it. And we're going to give you the opportunity for education and touch very, very quickly on how most of our American clients are using their retirement accounts to invest in real estate. So, who we are. Well, Jim Case is the manager. J. Douglas Schwab, who's been out to see Andrew in Phoenix, is our attorney. Anthony Salmeri, good Italian boy, is our property manager. John Chin is in charge of international sales. And I'm RJ Palano. I'm the guy that's out there selecting all the investments. I'm in every single house that we touch. We've done the research on, and my job is to make sure that we buy the right stuff in the right areas.
So, RJ, if you're talking about bad assets from a bank's point of view, that is merely an asset on their books that they don't want to hold, as opposed to an asset that's not worth holding from anybody's point of view. It's a bank's holding of a distressed asset, and more to the point, a distressed loan rather than a property that has no future.
That's exactly right, Andrew. And you know, banks aren't in the business of holding real estate. They're in the business of lending money, and I'm quite sure that they would like to get back to that as we've had such a hiccup in our economy over the last few years. So things won't normalize, I don't think, in our economy till the surplus of properties are absorbed. And we're doing our part to take all the good ones that we possibly can while this sensational opportunity is available. So what we do in a nutshell is very simply, we acquire selected cash flow houses. And when I say selected, I've bought bulk REO packages in the past from lenders, and in these packages they always throw in the garbage. There's always some good stuff, there's some mediocre stuff, and there's garbage. We don't want to buy the garbage for any reason. We don't want to put it off on anybody else. We just want the good stuff. So we're very selective.
The numbers that I hear is that there is 20% junk in most of those lists. 40 to 80%, which is sort of marginal to okay, and 5 to 20% that's worth owning, and maybe of that 5 to 20%, a quarter of it is home runs.
Yeah, in my opinion, Andrew, it's a sucker's bet. There's so much opportunity right now that people can and should be selective. So what we do is we actually buy the stuff with our own funds. We
So
rehab it.
you are the principals.
Absolutely.
Yeah.
And then we turn it over to the property manager who manages everything for us. And then we sell it to investors. So in a nutshell, we create a seamless approach for investors that aren't entirely familiar with how to get involved in real estate, because there are so many moving parts, like first of all selecting a region, an area of the country, then going into the counties, going into the cities. Then
Well, but before you jump ahead, one of the things we advocate for the so-called turnkey area is that the first rule is you're dealing with the turnkey vendor who is acting in the role of principal. They own the property. It's not some company like, some of the folks we know in Memphis who want your money so they can actually continue their business, and they act basically as a real estate-centric turnkey model, and really, because of that approach, don't really control the entire destiny of the investment. And that, to me, is a recipe for disaster, because the contingencies are then all pushed out to subcontractors. In your model, you own the responsibility until you've taken all the contingencies out of, the renovation costs, the time to lease it up, acquiring the right property. You've removed all those contingencies, as I understand it, right?
That's absolutely right. There's a lot of guys that are out there that they might sign a contract, but they don't have any intention of closing unless they can find a victim. I mean, a client that will buy that house with their money. We have the courage of our convictions, and we're confident of what we're buying, so we have no problem putting our money out. We're only going to buy stuff that we want to manage. And on that note, Andrew, guys have asked me in the past, hey, can you buy some lower price stuff in these other areas? And I said, sure I can, but not with my money, because what if you don't buy it? I don't want that stuff. We don't want to manage it, because you really hit it on the nail. The low income stuff, while the yield might be obtainable, it's only going to be obtainable for a while. It's not going to be a sustainable business model, and already some of these guys are starting to fail, and because I talk to a lot of these guys that do what I do, and they're going to have a tremendous amount of buyer's remorse from clients that within a year's time they already have vacancies and they got to go back and rehab.
One of the noisiest vendors, of course, is the guys out of Memphis, because last year they sold about 300 homes, but they sold half of them as agents, which is the model you just talked about. They put a offer in on a property, then hope they've got somebody in the pipeline that will pay for the property. And that way they can get a lot of stuff locked up, not necessarily stuff that's going to be a long-term hold, as you're, obviously taking that risk and hope that you're not stuck with it. And if you are stuck with it and it's one of these low-yielding properties for the long run, nobody will buy it. So you stay away from that by using your principal model. I applaud that. It's very, very important.
Well, it is important, Andrew, because a lot of people sell strictly for a commission, so they'll sell anything that anybody will buy. And early on when I got to Atlanta, I dealt with a couple of realtors, and we're constantly dealing with some of them in some fashion or form, not always, but we came across the pathological type that would say anything to anybody to get them to buy a house. And that's the nuance for a new person entering the market. Until you figure it out, until you really understand the dynamics of where people want to be and where to avoid, you could lose a lot of money. And we've lost money in the past, but the good news is we lost our money. We didn't lose any clients' money. And that's important. So what we do is we research the areas, we research the house. We have all the information on every school system in the area that we buy, because we want to buy in the better school systems, because that drives values. We look at crime reports on every property. We do searches on the median income in the area, because if you're in a low-income area, you probably got higher crime, not as good school systems. And then, of course, you're going to have more tenants in those areas than you do owners. So we like to see that percentage of homeowners to be well over 50% where we're buying. And with every house that Anthony manages, nobody can get into that house on a one-year lease. We don't want people that want to rent for a year, because the biggest expense in real estate, being a landlord, is turnover. And when you have turnover, typically you've lost a month's rent or two, perhaps because you're evicting somebody. Then you got to go in there and fix something. There's always something, whether it's paint, maybe the carpet, maybe cleaning out. And then you got to remarket and wait to get somebody in. So we want people, Andrew, that are committed to a neighborhood, committed to a property, and we give them an option to buy. And now, historically, 20 to 26% of the people exercise these options to buy. Candidly, we don't care. People need to be looking with a lens of at least 5 years for holding right now till the market gets totally absorbed and builders re-enter the market. But
So let me understand this. Not only are you interested in selling somebody into a rental that is occupied, you also have an exit strategy for that investor. So this is not sold on the infinite rental model, which is, again, what some of these characters that are so commission-driven, that's all they care about.
Absolutely. We want people that want to be...
Hang on, let me just make a point here, everybody. The rule that we are adopting or seeing come to the surface is there are three classes of turnkey companies. One is the real estate agent-centric model, which obviously RJ Palano and Buy Cash Flow Houses is not, because that's a commission-driven model. Then there is the get a sale now model, described as turnkey because they're selling buy and hold. And that, that the turnkey definition gets kind of fuzzy on that. But then you have this full cycle, meaning all the way to exit, full service turnkey model that you're presenting here, RJ. That is really what an investor is looking for, because infinite hold means that you restrict your income and your yield to just rentals, when there may be an appreciation opportunity and a blended exit, which bumps your return on that particular property significantly if you need the money in 3 to 5 years. An infinite hold means you've got to accumulate a lot of very good properties in a lot of very good neighborhoods to sustain that model, and I think you've got an answer to that also. But the point I make to you, RJ, you should be selling yourself as a full cycle, meaning investment cycle, full service turnkey model, because you have an exit strategy.
Absolutely. And, Andrew, to that point, everybody, when they're looking at any type of property, needs to know how they're going to get out of it. Every time I look at a house, there's two questions, and this has been going on in my head for 30 years, over 30 years. First, I go to the end of the driveway when I'm looking at a property. If I see a junk car in any direction, I'm in a junk neighborhood. The second thing is, when I'm looking at a house, I'm constantly, continuously looking for curb appeal. And the second question I ask myself is, who will pay more for this house? What type of person is going to want to go into it? Now, Anthony Salmieri, the property manager, he's actually incredible. He loves what he does. He has a passion about what he does, and he knows how to, for lack of a better expression, work the tenants to get as much out of them as he possibly can. And when he's working with these tenants, he knows how far they can go. He's doing all the due diligence on their backgrounds, their checks. He goes to their houses and see where they're living, and to make sure that we don't have 5 dogs, 3 cats, a rat, and a mouse, and everything else in there. He does all of that stuff. But most importantly, he doesn't ever mark up a fee or service, because property management, many companies, they're constantly marking things up, and you don't even know when you're getting hit with it, but it can be very painful. Andrews, what our investors want primarily above all things is safety. They want safety. They want sustainability with a predictable income that they can depend on. They'd like an above-average yield. They'd like to know that there's a component for future growth. They want to be completely passive, so we pay their property taxes, we handle their property insurance, everything. They don't have to do anything except look at the reports and cash their checks. And what they don't want is surprises. And that's why we give everybody a home warranty, and that costs us every once in a while. And I'll probably...
Well, I mean, what's interesting there is one thing that a lot of these guys on the high yield, short-term objective of selling a rental property, but not selling a long-term rental property, is there's always these surprise cash calls that come either during the renovation when it's being done on behalf of the investor as opposed to being done at your risk as you as the principal. But then also over the life of the property, often there are cash calls because, oops, the person moved out, there was more damage than there was anticipated, and days on market to get a new renter, the vacancy period stretches out. Somebody's got to pay the bills for the utilities, for the landscaping, for the maintenance, the debt servicing, and those cash calls, the surprises are often 2-3 months, and they've destroyed any income in that year on that property.
It happened just this last week. we sold a few houses to a gentleman from California, and this guy's a very sophisticated investor, and we give him a home warranty. Home warranty on everything. He did a home inspection on the properties and everything, and everything was fine. Everything checked out. We went back in, did a few things. Well, after the tenants moved in, it was determined that the air conditioning system was not big enough for the house. The home inspector didn't pick up on it, but we paid for it. We put in a brand new system, $3,800, and that's what our investors really have come to appreciate about us, because we take care of that stuff, because we don't look at somebody like, hey, we can sell them one house, let's get as much as we can. We look at everybody like, if we can do business with them one time, we could do it with them 2 times, 10 times, and over. That's why even right now I got a guy from Singapore coming back for the 4th time to buy, this time, 4 more houses. So it's important that people recognize the relationships and how important they are. So why we've selected Atlanta, and not many people know this, Andrew, but when I was buying bulk packages, I bought them in 12 different states, and I found out just how much fun that wasn't. Not having centralized, yeah, oh, it's not fun. Believe me, that not having centralized management was a killer. But then we were able to make distinctions on where the best net cash flow is, because people have to remember there's fixed expenses that never go away. Those are property taxes, that's insurance, and of course a management fee. It's a path of progress, and the high net cash return is so good, and our investors are buying for 50 to 60% of what it costs to build. Now, we do have more reasons, and that is the diverse employment sectors. We have 75% of the Fortune 1000 companies here. In fact, there was an article in the paper just this week, March 3rd and 4th, of how unemployment's going down and how more businesses are moving into the area. The low taxes are a very welcomed fixed expense here. Low homeowners insurance, because when you buy in places like Florida that's on the water, you've got the threat of hurricanes, and insurance companies never go out of business. They just raise your rates. And in fact, Andrew, as you know, I live in Tampa. My personal property where I live, which is valued at about $500,000 today, it was up to $750,000 about 4 or 5 years ago. They just raised my homeowner's insurance from $1,500 to $3,500 a year. And that's why we don't buy in Florida.
And you no longer get hurricane insurance. You now have to have separate wind and separate water coverage, right?
Absolutely, and separate sinkhole insurance, and that's what insurance companies do. They don't like to pay out, and when they do pay out, they figure out how to get it back fast. So Georgia's a pro-business state. It's a good old boy state. You know, we've had a couple of evictions here, and just to give you a contrast, we had an eviction in Detroit where they have trained tenants that know how to play the system. It took 7 months to get somebody out. And you know, they don't abate the property taxes or the insurance in that period, so the house is an absolute loser. In Georgia, in Atlanta, Anthony went to an eviction about 4 months ago, and he called me up. He goes, "Well, you're going to like this." I said, "Tell me the story." The judge comes out and says, "If you're a tenant and you didn't pay your rent, and there's something wrong with your house, I don't want to hear it. I'm going to throw you out. You better get in that back room over there and make a deal with your landlord, because if you owe the rent and you didn't pay it, you're going to be moving." And that's how Georgia is. It's beautiful for us. But there's other drivers here as well, Andrew. You've got all the baseball teams. You got basketball. You got football. The nightlife, which I don't see much of, is really thriving from what people tell me. There's theaters here. There's high-end shopping, something else I don't do. Top-quality museums. But the big thing is a broad economic base, which is so much safety for when there is a decline in the market. And if you take a place like Memphis that has 30,000 people employed by FedEx, if something goes wrong with Federal Express, that could really create a terrible ripple in that economy. Here it's very broad-based, and we like it. And there's information that they're making it the IT health capital of the country, adding 100,000 plus jobs in the next few years, and it's already starting, which is beautiful. So we like to take the risk out for our investors, so we give them a home warranty. All their paperwork goes through an attorney here in Atlanta that is bonded and insured and has errors and omission insurance, and we have a copy of that. They get title insurance on every property. They're welcome to get a home inspection, and they've got the benefit of experienced property management, which not enough can be said about the management of a property, because you could do everything right. You could buy the right house, you could buy the right neighborhood, but if you put the wrong person in that house, you could really hurt yourself financially. And here's an example on this next slide. This is the wrong house in the wrong area. This is one of the first houses I bought here from an unscrupulous realtor. And this is a 3-bedroom, 1-bath brick house, probably about 30 years old. Andrew, this was in Clayton County, which we don't buy in anymore, never. And this house, we couldn't get a tenant in this house for, and this has never happened to me before, a year. And when we did put somebody in there, the guy made up a story, and it was a nightmare. We've got somebody in there now, and we've made things right with the person that actually bought the house from us, because we gave them a tremendous discount on something else, and they came back and they bought again and again. So it's important. And I'm going to show you another slide here. This is the right house, but this house is in the wrong area. Andrew, when I came into town on this trip, I had this house under contract. It's in DeKalb County. And if you look at it, it's a beautiful looking house. It's a 4-bedroom, I think it was 3 bathrooms. And you go inside, and your typical REO, they steal stuff. The sinks are gone. The air compressors were gone out of this house as well. But the problem with this house in DeKalb County, which is much like Clayton County, okay, is that this stuff isn't going to go up in value. The median income is extremely low. The school systems are lousy. The crime rates are high. And while it looks like a good house, it's not a house that we would buy, because we don't want to manage it, and we would never want to sell it to an investor and put them into it. On the other hand, here's the right house in the right area. This is a house in Henry County in Stockbridge, and it's got the Union Grove school system, which is one of the top-rated school systems in the county. This house is about 2,700 square feet. It'll rent for $1,400 a month, and it'll throw off a net cash flow to an investor of over 10%. We've got a couple houses in this neighborhood, and we haven't done our rehab to it. And when you go in, this is how it looks in here. You can see red walls over here on your left. You can see totally carpet that's, you could clean that, and most of our competitors would, but we don't do that. We just toss it out. We start fresh, all new linoleum, all new appliances, everything. And that's how we attract a higher dollar paying tenant that wants that house. One of our tricks is this, is we just make our houses nicer than everybody else's, so when they go see somebody else's, ours are a much easier close for us. Now, this house here is a house.
I heard something very interesting the other day, and it was somebody who was doing mid-class houses, mid-market houses, and they said, the cost of a granite countertop now is such that it's equal to 1 month's rent. So if I'm doing a kitchen, the differential between a cheap countertop and a granite countertop is 1 month's rent. The time to rent that property is compressed by typically 15 to 30 days per rent up. So you get your money back within the first 2 tenants.
And that's smart thinking, and we do a lot of that stuff, Andrew, unless the house already has good stuff in it. But if you're going to replace it, you're better off to go further and go better, because you'll get it back in the long run. Now, here's a house that we had just completed in Henry County, and you can't really tell by the picture, but this whole thing has been cleaned up on the outside. It's been landscaped, and if you come inside, it's not a great picture of the kitchen, but it shows all new appliances. That's all new linoleum. That carpet that you see in the hallway is not the carpet. That was the carpet that came with the house. Then the next picture here just shows part of the living room after it was painted with a different carpet, which is much higher quality. And we use one of the most expensive pads out there, because that keeps the carpet it's going to last a lot longer. Whereas a lot of other guys, they would save the old dirty, filthy pad, or they'd put a really cheap one in. We put in a top-of-the-line pad. It's a much better feel. That fixture that you see right here above the fireplace, if you can see it, it's not there anymore. That's been replaced as well. And these are the kind of houses that we like. This is a house I just bought this week, and you would be amazed at this house. It's a 6-bedroom, 4-bathroom with an office, plus a bar entertainment room that's out of this world. And I don't have great pictures of the inside of it, but if you look at the back of the house, this is down below. You have that's where there's a second master bedroom with an office over there and a giant entertainment area. And then when you come out of the kitchen, you come out to this beautiful deck here. On the other side of the house, which I don't have a picture of here, is a a gazebo, which is just beautiful. The lot location is incredible. In fact, here's that downstairs room. We did have a slide of this, I forgot. All hardwood floors. The upstairs is all hardwood floors. You can see the two-tone paint stuff that we do, okay? And we just started on this house. We just started to get some of the stuff going on it. But this house is pure quality. I'd venture to say this house would cost it's about 3,000 square feet, at least 3,000, and it would cost $300,000 to build it. Andrew, a house like this we sell for $125,000. And that house is going to rent for $1,500 to $1,800. I don't think that you can find this stuff in Phoenix or anywhere else. I really don't.
No, you're absolutely right. And obviously, looking at the neighborhoods, this house is also then repositioned when you buy it as a retail exit at some stage in the future.
Oh, absolutely. In fact, this is a shot of the neighborhood there. It's on a little cul-de-sac, and you can see in the back that there's all trees. I mean, that house that you're looking at on your left of the screen, that's the house right next door to it. And you can tell this is a very well taken care of neighborhood. And, I mean, it's just got all the attributes that we look for: a good school system, an outstanding curb appeal. Very, very easy for us. Here's another house we just bought this week. This is also in Henry County. This house is a 4-bedroom, 2.5 bath. If you take a look over here, I kept this shot, and if you look at the side of the house, you can see there's a little mildew on it. We're going to pressure wash it and do a few things to it. But this house has a full basement in it, which many of the houses in Georgia do not. And it's got a few things that we're going to do to it, but it's just a great house. And these are the types of properties that we like to buy. And here's this neighborhood. As you drive into the neighborhood, you could tell beautiful houses, lots of room. These are the bedroom communities of Atlanta. We stay out of the loop where you have a lot of ghetto houses, or you have older houses. And older houses, you know, that are like 2 bedrooms and 1 bath, or a 3-1. There's just no need to buy that. When the average American wants a 3-bedroom or a 4-bedroom, at least 2 bathrooms, we just don't buy that stuff anymore. I showed you that one house that was in Clayton County, and we wouldn't buy another house like that for $10,000. We just don't want it. So we take a common sense approach to business, and really it is common sense. You know, this real estate business that I've been doing for over 32 years, you know, some people say it's a science. I think it's more of an art form. And when you take all the experiences that you've had over time and you add those up, it forces you to make distinctions to buy houses in the right area. And it's so critical right now in the United States to buy where people are moving to. And you're able to buy, there's so many houses available, you can buy newer houses. And we suggest people buy in the middle income area. Where people are, because otherwise they won't cash flow right. And then in the best price range. And that best price range, I define it as this, Andrew. I define it as the first-time home buyers price range, because that's a segment of our market population that will never go away. There's always going to be new people coming up that want to buy a house.
Well, the reality is, when you do the demographics and you do an income split, for every $1 million house that's sold, you mean classing as luxury, and you know, the numbers are not quite as strong when you get into you know, above jumbo rates. But for every $1 million house that's sold, there's over 1,000 affordable houses sold. So
absolutely.
If you're trying to make money in a market, go where the market is. Don't go where you think the market is.
I couldn't agree with you more. The higher up you go in the ladder of price range, the lower your cash flow is going to be, and it doesn't mean that you're going to get a better growth. We're looking for things that are driving growth, because that's how people get filthy rich in real estate, is by buying where the prices are going up. And in the meantime, they've got the safety of a nice cash flow coming in, typically 9 to 11%, sometimes 12%. But that shouldn't be the main driver. The main driver for everybody when they're investing right now should be safety. And part of that safety is doing your own due diligence. Nobody should take everything I say as the gospel truth, nor should I take anything that anybody else says as a gospel truth without doing a little common sense research to make sure that you're getting what you're supposed to get. And Andrew, that's why we invite all of our buyers to come here. We invite them to come to Atlanta. This last week we've had people in from Las Vegas. Today, in about 15 minutes, I got people in from Australia. Tomorrow, Toronto. The last week, I also had people in from Calgary, and we've got somebody in from San Francisco tomorrow evening, a repeat buyer. And These are smart people. They're getting on a plane. They're putting out money. They want to see it. They want to feel it. They want to touch it. And we highly encourage that. And for those
Now,
that can't.
I heard you say before, RJ, that a couple of these folks came to you as a result of our magazine.
I don't want to say that again because I don't want my rates to go up. There are some, yeah, there are people. There are people that yesterday I spoke to a guy, believe it or not, from Manitoba, Canada, and he said he was down in Phoenix and he found your magazine, and he was reading about us, and you know, he's buying from us this week because of the credibility that's been established by the results.
Well, the inside baseball joke there is. RJ told me about that, and I warned him that you never tell a publisher how good the advertisement is performing in the magazine because he's likely to see an increase in advertising rates. I was, of course, joking, right?
That's all good. So there's certain things that investors need to know to avoid like the plague, and that's older housing stock. If you buy something before 1978 that was built before 1978, there's a doggone good chance it's got lead-based paint, and that's a lawsuit you don't want. Trust me on this. I had been sued for houses that I owned 18 years ago, and the insurance companies they don't cover that because they could lose money, so they immediately omit that stuff. But I got away from the lawsuits. But the important point there is, there's just no reason to buy that. Old houses have new problems. And when you buy in places like Niagara Falls, New York, for example, or maybe Cleveland, Ohio, you're talking about sewer systems and water systems that have been built 100 years ago. These things are leaking, they're failing, they don't have the money to fix them. What they do is, for the people that escape and move to another part of the country, it's the people that are left behind that are left paying higher fees on property taxes, or any other fee that they can come up with, water bills they come up with, garbage bills. They just make up new fees going along to replace the income from people that are leaving. So avoid areas of declining population. And what I tell people is this, Andrew, we used to have a manufacturing country here. Back in the 60s, 54% of our population was in manufacturing. The workforce was in manufacturing. Today, it's 9%. So the areas that got developed for industry way early on, up in the Northeast and the Midwest, you know, those industries are gone. Other stuff has replaced them to an extent, but then you also got to think logically. As people get older and they realize that the sun does come out more than 60 days a year in Rochester, New York, they want quality of life, and they're moving. And as boomers are retiring right now, 10,000 baby boomers a day, they want quality of life. They're moving south. They're moving somewhere south where the weather's warmer, where they can do more things and have a more enjoyable life to their last days. Florida used to be the big draw, but the cost of living has gone up there so much because of insurance and because of property taxes that there's actually an exodus of population. So in those areas that are prone to natural disasters like Florida is with hurricanes, it gets very, very expensive. And we tell people to avoid condominiums. I've been involved in many, and they change the rules. You have homeowners associations. When things go bad, they cut back services, or they have special assessments. But the bottom line is they're voting on your money, and they're like the mafia. Once they get into you, they never leave you. I had a condo in Charlotte, North Carolina, that I was doing a lot of business up there, and then I decided, nope, that's not it, man. The place is Atlanta. I went to rent it. They told me I couldn't. I said, no, we just passed something. We can't have any more than 15% rentals. I said, well, it's a tough market to sell. Yeah, we know that. Sorry about that. And I basically gave away my condominium. But they changed the rules. And the other thing you want to avoid is liberal states. And Detroit, New York, Massachusetts, California.
Well, hang on here. That's a political statement. We don't want to take sides here, but when it touches the pocketbook, and we have a danger of electing somebody that wants to get further into our pocketbook. Are you saying that liberal states and liberal politicians are a little expensive for the average person here, RJ?
Let me say it to you like this. When you're investing in an area and all of a sudden they want to license your property before you can have somebody move in it. That means building inspectors come out and they say, well, we want all new hardwired smoke detectors. We want you to upgrade the plumbing and the electric. Or they want to license you as a landlord like they do in some places in New York State. That's a bad place to invest.
Oh, we've had people try to do that. Liberal cities in Arizona or liberal politicians in Arizona in some of these cities have decided that it's time to invoke a landlord tax and a landlord licensing system. Needless to say, the local REAs in their lobbying operations, swung into high gear along with the multifamily people, and they knocked that back pretty quickly.
Well, that's good for Arizona, but that stuff is full blown up in the Northeast and the
Oh yeah,
Midwest.
absolutely. It's one of the reasons why it's hard to be an investor and make any money in some of those Northeast states, and why people like you benefit in Atlanta.
Absolutely. And the other part that people just don't think about is it snows up there and you've got winter. And if you get like last year, here's a perfect example. We had a house in Detroit and the tenant moved out in the middle of winter, didn't tell anybody. Well, you know what happened next. The water pipes broke, froze. I had a 10 by 10 block of ice in my kitchen. And then in Detroit, it's such a beautiful place to do business. It took us a month to get the electric company to put the electric on because the last person didn't pay the bill and they thought there was fraud. But it's not like they can do it in a day or two. It takes them 2 to 3 to 4 weeks. Meanwhile, you've got an ice castle in your house. And, when you've got winter and you've got the constant freezing and contraction of moisture in your walls and stuff like that, things decay a little bit. And those properties up there are old. There's just no reason to buy that stuff in today's market while it lasts, because this is a limited time. This isn't going to be like this forever. This is the best time to get involved in real estate. So we have two models, what we use, Andrew, for our investors. It's very simple. We're in business to make a profit like anybody else. And if anybody tells you that they're not in business to make a profit, well, they probably won't be in business for long. But we buy stuff with our own money. We fix it with our own money. We hand it over to Anthony, the property manager, separate company. It's him. We oversee him because that's our property. We want to make sure he's doing everything he's supposed to do, when he's supposed to do it, how he's supposed to do it, and we examine his books monthly, and he does a phenomenal job. And then we sell it to investors, and they own 100% of the house. That's model number one. Today is the day of the unveiling of a new model. My own office doesn't even know about this model, and when I hit this slide, this is going to be the first time anybody ever hears about it. Here it is. It's a new participation model, and here's what we're going to do. People can buy houses from me at my cost, exactly what they cost, plus the rehab, and a $3,000 acquisition fee. That way we've got sustainability that I can continue to do this, and I got enough money to pay my overhead. And they're going to get 100% of their net rent for 2 years, 100% of it. The only thing that will come out of that is the property taxes, the insurance, and the management fee to Anthony, which is always 10%, and then when he sells stuff down the road, he gets a 6% commission that he might have to co-broke with somebody. And that's a typical realtor fee anywhere in the country. But the great thing about Anthony is he never marks up any fee or any service. Like today, he's got guys putting out bandit signs, and it's costing him $3,000 out of his pocket because it's that time of the month where he hits this thing, and his phone will light up like you can't believe. And in this model, after 2 years, we share 50-50 with the rent and on the upside. So the investor, there's some tremendous benefits here to the investor. The benefit of this model is the investor avoids our upfront profit, okay, which we're entitled to make, but they can also get involved in more opportunities, and there's more safety because they've got more.
Hold on. You're entitled to make a profit. Isn't that liberal politician trying to stop that?
I guess it's well, there are some people that get concerned with what anybody makes on any type of situation, and for those type of people, we just don't really have time to talk to them because they don't really understand business. People can't operate if they don't make money. Anthony couldn't
exactly.
Yeah, Anthony, you couldn't operate if people didn't pay your fees, and you make your fees, your advertising fees. They're reasonable, they're fair, or people wouldn't do it. So it's simply business. It's capitalism. You charge a fee for a service. If you provide the service, people come back. If you don't, they don't come back. You lose them. But this opportunity.
That's what's a part of the charm of this full service, full cycle model that you're proposing here, and particularly with this participation idea, because this allows somebody to expand their portfolio pretty significantly.
Well, again, nobody in my office even knows that I was going to bring this out today, and I've debated on this for a long time. But I think, if an investor gets into a house, and let's just say it's a phenomenal property that I put them into, and let's just say it's $100,000, and in 2 years now they only got maybe 80 into it or $75,000 because they got all the rent. They were able to get into more. They know I'm going to be participating, so they know for sure that I'm going to pick out a great property for them. And some of these properties, it's not always 100. We've got stuff in the 70s, and we've got stuff up to about 125 right now. So this is just something we're testing. I think that there's a tremendous benefit for people that are so concerned about comparable sales, because comparable sales don't mean a thing in this market, and people just lose sight, and it gives them a reason not to buy. All comparable sales right now, they're all distressed, but unless you go into those properties and see the air conditioning's gone, the rugs are shot, the linoleum's ruined, the copper's been stripped out, and they took out the coils for all the air conditioning and stuff, they don't realize it. What people need to look at, in my opinion, is one, cash-on-cash return is very important, the future upside of a property, as well as the safety of the investment, where it's located. And I think when you look at the cost to build, and when you're buying at 50% of what it would actually cost to build that property, I think in the system that we've created for people, because really it's a system, you're really not buying a house when people get involved with us, Andrew. And that's probably the biggest point that I can make today. They're really buying into a system. And it's a system that we're constantly fine-tuning, making better, with the foresight of knowing that if we treat people the way we want to be treated, that they're going to come back, they're going to be happy with our service. That will make us happy, because that's what it's all about. You know, wealth isn't how much money you got in the bank account. It's the quality of the relationships that you've created over your life, and we believe that stuff. We believe in reaping and sowing. We believe in putting a good seed in the ground. We're going to get a good crop. Likewise, if you put in a bad seed, you're going to get a bad crop. So for people that need more education, there's an email up there, and that's John Chin in our office, and he's created some terrific videos, and that's john@safecashflow.com. And that's my office line up at the top. But you also have, for people that are really ready to take the next step and want to take action now, that is the wrong email address I'm noticing. It should say rjp@buycashflowproperties.com. So, folks, I hope you're listening to me. It should say rjp@buycashflowproperties.com. Otherwise, just call that cell phone number there. That's me. I answer it unless I'm in a meeting or doing something, but I always return my calls quickly.
Well, RJ, thank you so much. And what I'd like to do is, if you'd send me all the right details following this this webinar, we'll send an email out updating all that stuff with hyperlinks and so forth to the people that attended this this webinar. RJ, thank you so much for your time. I reinforce the statement I made on the way through. It's very clear to me these folks are offering a full-service, full-cycle model for turnkey. They're not just trying to ship you into property and hope they can then, you know, fill in with tenants for the life of your ownership so you get somewhat close to what they promised you could make. This guarantees it as near as they can, because you're buying something with no contingencies in it. What you see is what you buy. It's renovated. It's tenanted. The spreadsheet is already cash flowing as represented. And then with this new participation model, they're showing you a way to get into more properties at a lower number, but build your income spread as well and over time. So that's an interesting model where you guys are also, RJ, you're incented to produce.
Absolutely, and that's what we like to do. We like incentives. I believe everybody should be paid on incentives, no matter what it is. You're paid to perform.
Great. Well, on that note, Buy Cash Flow Properties and RJ have been a great client, and let's put them to the test and see how they can perform. RJ, thank you so much for your time.
Andrew, same to you, my friend. Have a great day.
God bless.
You too. Bye-bye.